Hey, Zach, love your videos. Was wondering if you could give advice for virtual wholesalers when it comes to filing taxes on profits from wholesaling. Okay. Now, uh, just gonna be honest with you guys. I'm not a lawyer, CPA, financial advisor, any of that stuff. Hey, I'm just a real estate wholesaler. I'm not licensed. I'm none of this stuff. So that being said, don't sue me, bro. Don't sue me, guys. Like, don't sue me. So made it clear. I'm not a CPA, financial advisor, lawyer, attorney, blah, blah, blah. Like, I'm not a realtor either. So that being said, so for virtual wholesaling, when it comes to filing taxes and profits and doing all that stuff, there's a million things you can do. In my personal opinion, I will tell you the cheapest thing to do is to file the right corporation depending on your income. Now, some incomes, if you're under $300,000, an S corp might be better if you're married. If you're under 150, S corp might be the best. Again, I'm not a lawyer. Like, if you guys are a lawyer, you might be screaming at me right now. I don't want to give you advice. This is just general what I've seen. For virtual wholesalers, though, to get the best one, I recommend an S corp, LLC if you're under 50K. And then over 300K, probably a C corp is probably the best for you. Depending on your state, I'm in Florida, so there's no state income tax, which makes me a happy guy. But I would say not out of 9 corporations I work with or work on, basically with all the businesses that I run. I got some crazy ones outside of real estate too. They're basically C corps, and that's it. And then personal assets, I mean, we got those too. So the only one asset, just make sure you guys are buying assets and you can write them off, but don't be scared to pay taxes. Like, if you have, like, I know so many guys are like, oh, I'm so scared to pay. Sometimes you just got to pay taxes and then put that into like cash flowing assets. And then from there, I like the Grant Cardone rule. He's got a 40% rule, which I think is pretty awesome. What he says is 40% of your income, you probably have to pay that in taxes. That other 40% you put into investing, and then the 20% is what you live on until you can live on your passive income.